Alrighty. So in today's video, we're going to be talking about how to consistently grow a small account with options. So if your account size is, let's say, less than 20,000 or even smaller, less than 10,000 and even less than 5,000, then I'm going to show you a strategy that can help you consistently grow that account. So I have a number of my subscribers. They actually asked me, they reached out to me saying that they're actually struggling to grow their account. And the main reason is they are using strategies like the credit spreads. Now, credit spreads can be a pretty good strategy to grow your account. The one of the issues that many people face is that credit spreads tend to be a little bit more directional than some of the strategies, especially the strategy I'm going to share with you in this video. So if you're not very good at, let's say, picking direction, then credit spreads can be a challenge, right? So in that case, if you want to consistently grow your small account, then what I would suggest is to use a omnidirectional strategy. And the one that I suggest that you can consider using to grow your small account is what it's called the put Condor. So I've actually covered this in a previous video, but for this video, I want to go a little bit more into the details of how you craft the strike price on the option chain so you can actually cater it to your own account size. So very quickly, the put Condor basically is two strategies combined. All right. So the very first strategy, as you can see on the left hand side down here, is the short put and the long put, which is the bull put spread, right? Bull put spread, also known as the put credit spread. And because it's a credit spread, you're actually going to receive premium for it, right? So you're going to receive premium. So let's say you have premium. I'm just going to put like, let's say $3 signs to say that, hey, you've collected credit, right? So with this credit that you receive from putting on this put credit spread, what you're going to do is to use part of it to actually purchase this part on the right hand side down here, which is a put debit spread. Right? So you notice down here, you have two kind of opposing strategies together to form this strategy. You have the short put spread, which is generally a bullish strategy. And then you have the long put spread, which is generally a bearish strategy. So that is why you form this graph down here. So you can see this line down here in green. Let me just draw over it again. So this is how the P&L looks like at expiration. So one thing you will notice is that there's actually no risk to the upside, right? That means to say if the market rallies all the way to the top, so this is where the current price is. If the market goes all the way up, so you can see down here, this is the price scale, right? So the current price is around 500. If the market goes up to 510, 20, 30, there is no risk. So this is slightly different from the iron condor, which many people trade as well, which they are used to, right? For the iron condor, you have risk to the upside, right? So it's a mixture of call options and put options. For this strategy, we're only using the put options. So with the credit that you receive, you need to purchase this put debit spread, this long put spread, and you want the cost to be lesser than whatever credit you receive. So if you receive a credit of $1, then you want to purchase this put debit spread for less than $1. So if you purchase it for less than $1, that is how you can get no risk to the upside. So that is why this strategy is actually pretty good, because it also has a pretty high win rate. Now, the next thing I want to share with you before we go on to the option chain is the put Condor statistics, right? So as you can see down here, if you were to put on the strategy for at least 100 trades, so this is the last 100 trades statistics. Very important to put on the strategy for at least 100 trades, because then you will have a much better indication of the true performance of this strategy. Now, to get the true performance of this strategy, or any option strategy for that matter, you need at least 100 or more sample size, right? You cannot just take only 5 trades and think this is, the strategy. Because if you just do that, hey, look at this, right? There will be losing streaks, right? This is just part and parcel of any strategy. You will have losing trades, right? So if you were to just only take like 5 trades, 10 trades and think that that's the true performance of this strategy, then it's very difficult for you to be, successful when you trade options, right? Or even to consistently grow your account. You need to be there for the long game. So that is why proper capital allocation, again, very important. If you put it past that losing streaks which you have down here, right? This losing streak, if you go past it, you continue to put on the trades, then you will start to reach a point where the probability will start to reach its true probability. So in this case, you can see the win rate is roughly 91%, right? So I won't go through the rest of this, but overall, what you need to know, this can be a profitable strategy, but again, comes down to the mechanics, how you put it on. So how do we actually put on the put condor? Let's get to the option chain right now. By the way, if you like this video so far, please subscribe and also click the thumbs up button, and also do get your free copy of the Options Income Blueprint, where I share the top 3 option strategies that help you generate a consistent income each month, trading just 1 to 2 hours a day, right? So if you want to go ahead to get this copy, just head on over to optionswithdavis.com/blueprint. All right, back to the video. Okay, so this is the option chain on the Thinkorswim web platform. Now, whichever broker you're using doesn't matter, because most of the option chain should look pretty similar. So the very first thing we want to look out for is the DTE. DTE is basically the option expiration date, days to expiration. So as you can see down here, there are quite a number of choices to choose from. So let me just get my marker out here. So as you can see, there are so many dates to choose from. So which one do you choose? So for me, my preference, if you have been a follower of my channel for quite some time now, you know I like to go around 45 to around 65, 70 days like that, because that's where we have an edge, right? The edge again is where the realized move is most often time lesser than the expected move. Again, if you're new to my channel, first time you're watching my video, just go to my channel and look for the video, the #1 secret to becoming consistently profitable trading options. You will find that I have a video that talks solely about this. All right, so this is a very important concept for us to have an edge trading options for the long term. So basically, to have this edge, DTE is also pretty important, our choice of DTE. So our DTE choice will be somewhere around 45 days. So as you can see down here, we have a few choices. So the closest one that we have would be this one, right? As you can see, it's 59 days. Now, some people love the 0 DTE or even the 1 DTE, or some, they want to go to 7 days out. Can this also work? The only difference is whether you have this edge, right? So if you want this edge, you want to stick to around 45 DTE. If you don't mind not having the edge, or you think that, 0 DTE or weekly options have been working out for you, that's fine. Yeah, you can go ahead to try and construct it there as well, right? So for this video, I'll focus on around the 45 DTE. So what I'll choose is basically this one down here, April 20th. So let me just open it up. So as you can see down here, there are quite a number of strike prices. So the very first thing we always construct for this strategy is the put credit spread side. Why? Because that's the one that's actually giving us the credit, so we know how much credit we have to construct the put debit spread, right? So for this, we want to go to somewhere around 15 to 20 deltas. So again, why 15 to 20 deltas? Because that's where the expected move is. That's roughly where, again, we have, a edge when it comes to statistics, right? Long-term probability, where there's a lesser chance that the market will actually go there. So because this strategy has only reached to the downside, we want to position our short put strike pretty well. So in this case, let's say, for example, you go for the 20 deltas one. Right, so let's say you go for the 20 deltas one. Now, where you construct the long strike for this put credit portion of this strategy comes down to your risk allocation. So this comes down to your own account size. So let's say you have a small account size, and let's say your risk per trade is $500 per trade, right? So if it's $500 per trade, then all you got to do automatically, just go to the $5 wide wing from where your short strike is. So 474 minus 5, if my maths didn't fail me, 469. So 469 to 474, you have a $5 wide strike. So down here, you can see you have roughly 58 cents. So 58 cents is not a lot, but hey, you have a small account. That's what you got to play around with. That's what you have. So now that you have constructed the put credit spread side, we want to construct the debit side, right? The put debit spread side. So this is where we will go all the way to around where at the money is, right? At the money is basically, you can see on your option chain, there is the darker shaded one, right? Or a different shaded one from the one that is out of the money, right? So again, depends on your option chain, the broker you're using, but you can see down here, this is where it's in the money, right? To confirm, just look at the price at the top, right? The price at the top down here, oops, you couldn't see that. Let me hide that. it's 496. So we know that this 497 is considered pretty much in the money for put options. So anything that is out of the money is below this price. So what we want to do is select our put debit spread somewhere below down here, and where we select it again depends on how much credit you have to play with. So let's say, for example, let us try this one that is just right at the money, that is out of the money. And let's try and construct a 1 point wide spread. So as you can see down here, you can get a credit. So it is a 20 cents credit, which means to say that you have an overall profit if the market goes up, right? So now that you have constructed this, let us go down to take a look at the P&L graph. So the P&L graph is pretty important because it shows you how your P&L looks like at expiration. So you can see how it looks like down here. Now your max profit zone is somewhere in the middle down here. Above down here, you still get some profit, and below down here is where your max loss is. So as you can see, it's actually not too bad when you have this construct. Your max loss is around $380. Your max profit is around $120. So your risk reward is roughly 1:3, which is not too bad. Now, what if you want slightly more credit upfront? So for this, we will have to go back to the option chain again. And then what we want to do is change these strikes down here. So how do you change these strikes? Basically, you just want to shift this whole put debit spread up on the option chain, right? Up on the option chain just means you're pushing it further away from where the current market price is. Because when you push it further away from where the current market price is, it becomes cheaper, right? The put debit spreads becomes cheaper. So let me just give you an example to show you down here. Let me just uncheck this two first. So let us remember it's 474, 469. We will come back to it later on. So remember, we're going to use the credit to finance the put debit spread. So we want to see what is the cost of this debit spread down here. So this cost of this debit spread from 496 to 495 is about 39 cents, right, which is $39. Now, before I compare this to the further out of the money debit spread, right, I want to just show you something pretty cool down here, and that is the risk to reward ratio. So you notice that you actually get pretty bad risk to reward ratio when you're trading the credit spreads by itself, right? The risk is always much bigger than the max profit that you can receive. But for the debit spread, it's the opposite, or more specifically for this put debit spread. You can see down here, your max risk is $39, but your profit is about $61. So it's roughly about close to 1:2. So this is where I'm going to show you what if we actually bought the further out of the money put debit spread. So as you can see, this is 39 cents down here. This is a debit, so always make sure you know what is this number here telling you. So let's say, for example, let's go to the one down here, 490 and 489. So if we buy this put debit spread now, you notice now it's cheaper. Now, because it's cheaper, we actually have a better risk to reward ratio. So take a look at this, right? So your max risk right now is $29, but your max profit is $70. So all of a sudden now this is slightly better than a 1:2, right? It's a 1:2 point something, right? Maybe 2.5, close to there. And as you get it further out of the money, if you buy the put debit spread further out of the money, you actually get a much better risk reward on your debit spread, which means to say the market comes down, you can make more. So now let's put on the credit spread side, the put credit spread. So if you guys recall, it is, what is it again? If my memory didn't fail me, it's 474 and 469. Right, so we have a 5-point wide. So as you can see down here, now we have 29 cents in terms of the total credit. Now let's take a look at the P&L graph down here. So what you'll notice, one thing is that the P&L graph down here, you get slightly more, right? Because you have more credit up front. So that is why you're able to get a slightly higher max profit. And at the same time, if the market goes up, you have slightly more as well, right? You have $29. Now let's compare this to the previous one, right? The previous one was right at the money down here. So what do we get? As you can see, we only get about $20. So the difference is about $9. Now I know it's very minuscule, but hey, you have a small account, right? You have a small account. This is all you can play with. As your account gradually grows, you can start to increase your size, and you will reach a point whereby the profit, you know, in terms of numeric dollars, can be pretty good. So right now, you just have a small account. You just have to play around with what you have and just consistently grow it with these strategies. So I want to show you the difference between, you know, one that is closer to where the current market is and another one that is slightly more, you know, further out the money for the debit spread. So the difference will be where your max profit zone is. So you notice that your max profit zone actually shifted a little bit out from where the current market price is. So this red dotted line is where the current market price is. This is your max profit zone, right? So as you can see, your max profit zone has shrunk a little bit, and previously you have a bigger max profit zone. So again, this is a trade-off. If you want much more credit upfront, then you have to settle for a smaller max profit zone. If you want a bigger max profit zone, then you want to, give up some of the credit upfront. So it's all a trade-off, and it all comes down to you. Now, what if you have a slightly larger account that you can risk more? Then, hey, all you got to do is just adjust the put credit spread side, right? So let me just remove this again and let's construct from scratch. So again, let's just use the same example as just now, 475. So now instead of 4 points wide, what you could do is stretch it to however much your risk is. So let's say you have a slightly bigger account, you can risk up to $1,000. Then you stretch it to 10 points wide. Right? So if you have a bigger account, you can stretch it even further. So let's say for this 10-point wide, you notice now you have much more credit to play with. You have $1.10. So let's see what we can construct down here. So if we were to construct the same one with just a 1-point wide put debit spread, you notice now you have much more credit upfront, right? $71. So 71 cents equals to $71 for every put condor that you put on. So as you can see down here, $71 to the right hand side, and your max profit is 171. Now, if you want to be a little bit more defensive, then what you could try is expand the size of this put debit spread. So if you go for a 2-point wide spread, now your upfront credit is lesser, 33 cents, but the trade-off is now you have a much higher max profit. Right down here, you can see now your max profit is $233. So if you want to be more defensive, then you want to build a bigger put debit spread. But if you want to have more credit upfront, then you go for the one that is 1-point wide for the put debit spread. So this is how you put on the put condor strategy, and I do think that this is actually a pretty good strategy for you to use to consistently grow your account. By the way, if you like this video, then you're absolutely going to love this next video which I have for you, so go ahead and watch that video right now. Also, if you haven't already gotten your free copy of the Options Income Blueprint, you can do so just by clicking this link down here on your screen, and you'll be able to get it for free. Alright, I will see you in the next video.